thank you very much, Rama, for this introduction, and thank you very much for inviting me to talk to this seminar. And indeed, it's a candid, I would say, pleasure I have to share with you this piece of research, because it's basically something we've done internally, and I'll be happy to gather some feedbacks, because this topic is quite important. But when you dig a little bit more into how it should be treated at a portfolio level, you find surprisingly very little about, I would say, the methodology. So here, our aim is to discuss about ESG investing at a portfolio level. So let me describe a little bit more. So first of all, ESG investing, it's topical because, as pictured in this cartoon, there is a very significant, I would say, growth in so-called ESG investments. So it's not perfectly well defined, but if you look at, I found a chart here on Bloomberg. If you look at the growth of AUM, it's really extremely quick. It's still a small part of the total fund industry, but it's growing extremely quickly. Practically, what is ESG? ESG stands for environmental, social, and governance, and it means that you are trying to route your investments towards those, I would say, corporations and issuers which play let's say, a positive role and a positive contribution to society. And obviously, having said that, how do you measure ESG? I would say many I would say a company have specialized in providing a so-called ESG rating. Some of them, MSCI to start with, they have a scale between 0 to 10. And if you are rated 10, it's the best possible rating in terms of ESG, meaning that you contribute very positively to ESG factors. Whereas if you are rated 0, basically you're doing evil. Morningstar, well-known also rating provider, has a different scale, but it shares the same, I would say, structure. It's between A and B, but it's inverse scale. If you are 0, you are very good, and if you're at 100, you are very bad. Obviously, a very key difficulty is how do you, what is it exactly, what does exactly this ESG rating stands for? So you could wander on the internet and you have some definition. So here I have the web page of MSCI. So MSCI, they say that they aim to measure the resilience of an investment to long-term risk and opportunities arising from environmental, social, and governance issues. So as you can see, MSCI, in some of the publications, they take ESG not as a good or bad investment, but as a risk, as an exposure to some factors related to ESG matters. If you look at Sustainalytics, they also put ESG risk rating methodology. And why do they do that? It's because talking about and measuring good and bad is extremely difficult, whereas measuring risk is more, I would say, usual, and you have more tools. So practically, if we want to now to think about how to, what's the issue we will face with this rating. So in all what follows, I will consider that an ESG rating is a figure between 0 and 1. Okay, 0 being the best possible ESG rating, and 1 being the worst possible ESG rating. Okay, but after you can do any transformation between that 0, 1 and the 0, 10 or 100, 0. But just for the sake of clarity and I would say putting the problem and phrasing the problem. So typically, if you look at Morningstar and I would say the most widespread industry approach, which is basically driven by the mutual fund industry, you have an ETF, let's say ETF on the S&P 500. What is the ESG rating of an ETF of the ESG 500? It looks quite natural to perform a weighted average sum of the ratings. So if you have different ratings between 0 and 1, you perform a weighted average rating. Nothing, I would say, no need for rocket science here, and you have a rating for the portfolio. And it works well if you think about it, because basically it's a convex combination of rating. So the convex combination of rating, at the end of the day, it's also rating. So basically you are not worried about much. Where the difficulty starts, and it's quite brutal, I would say, but as you can see, it's not, is that what about hedge funds? And more specifically, when I'm talking about hedge funds, I'm talking about those strategies where you can be long, leveraged, meaning where WI here can be above 1, or you can be short. And here you face an issue, because if you are short in this formula, it simply doesn't work. You very quickly understand that you go nowhere, because if you are short, then of a rating of 0.5, you obtain minus 0.5. It's no longer a rating, because it has to be between 0 and 1, and it's not just a technicality. It simply doesn't work. And for the leverage, it's the same. I mean, you leverage 3 times a rating of 0.5. You don't know where you are. You don't know what it means, and there is no easy way, I would say, to escape that difficulty. And because of
what do you mean
yes,
it doesn't work? What?
I mean that if you want a rating to be something between 0 and 1, the weighted average sum of ratings, when you allow the weights W to be negative, it just you simply cannot guarantee that it will still belong to 0, 1. And if you take a short position of a rating of 0.5, if you take a weighted average approach, you end up at minus 0.5. And so it's meaningless, basically. And you have the same problem when W is equal to 3, let's say, 3 times leverage on whatever index you can imagine, you end up outside 0, 1.
Well, why can't you say, for example, a leverage position of, say, leverage 2 is is equivalent to changing the weight? So for example, if I have a leverage position with leverage 2 in an instrument with notional 1 million, then I should really count the weight by using 2 million, and then I renormalize the weight.
Yes, but the normalization is not straightforward, because if you are long 100% of your wealth and short 100%, the weight might be 0 at the end. And so indeed, you are looking for some normalization somewhere, but the right one is not immediate. And if you want to rate, I would say, large portfolios, you want something where you are sure that whatever portfolio, whatever position you would consider, you don't end in something which doesn't make sense. So maybe it's the right moment to say that there might be other way to proceed than the one we propose, but we wanted to have a methodology which was sound, and where you are sure that you end with results which are meaningful. We didn't find anything in the literature on the matter. And our personal experience at Metori is that when you discuss with the UN PRI, which is a body of the United Nations to promote social and responsible investment, they tell you that basically this short issue is such a blocking point that most of hedge funds, they just consider that they cannot communicate on ESG, because they just don't know how to do. So it's really a blocking point for the industry, and this is why we wanted to elaborate a bit on it. So in the sequel, what I will first discuss, I would say, qualitatively about short, long, short leverage. I mean, what we can say, or what could be the different approach. Then I will propose a differentiation between ESG risk and ESG rating, so to differentiate two concepts. And then a proposal for computing aggregated ESG risk and ESG rating for basically whatever portfolio. And I will give an example with our own fund, since we have the transparency on it. Okay, so as discussed, if you look at here, no, it's not on that one, but sometimes when they communicate, MSCI and Morningstar, they talk about ESG risk or ESG rating. So if it's a risk, it should be proportional somewhere to the size. If it's a rating, it cannot because it belongs to the run. So there is a normalization, which is very important here. And there is also a notion, which is has it to be notional based or has it to be risk based? Because if it's a risk, obviously the notional can be a very misleading, I would say, indication of the risk. And what I have in mind typically is, so to start with, imagine a series of products on the S&P 500, one with leverage 50%, meaning 50% S&P 500, 50% cash, the full S&P 500, and a product which is leveraged, let's say, 3 times S&P 500. So should they have the same ESG rating? And another question we should ask is, what about the cash? Because if it's 50-50, it seems intuitive somehow that the cash doesn't play much role. And why do we think that? We think that because the cash has basically no volatility. And so we have somewhere, somehow, a vision which is risk-based. So thinking about it, to guide our thinking, we think that ESG rating should be related to risk, and so somehow be risk-based. If ESG is defined as a risk, then there should be something like ESG risk, and there the ESG risk should be somehow proportional to the position. And then if this is a risk, we could see ESG risk as a fraction of total risk. Okay, so somehow, if this is a risk, it's a part of the total risk. And we also will seek to interpret ESG rating as a ratio between the ESG risk and the total risk. So instead of divided by the weights, as you were proposing, Rama, possibly another way to kind of normalize is to normalize by the risk of the portfolio itself. And the nice thing is that if you normalize by the risk, normally if you have a good measure of risk, you will immediately incorporate correlation, volatility, and all the dynamics about risks that you know. And here I'm in the vision of risk, which is volatility based. Of course, you can extend all what we've done or propose something with other measures of risk. Short and long short position. So the way the discussion starts in many situations regarding shorts is so it depends on the region, and people in continental Europe do not have necessarily the same view as people in the UK or in the US, but generally is just simply is shorting a legitimate action. So is it legitimate? And then after you move from is shorting good or bad? And then, so is shorting a bad rating good? Is shorting a good rating bad? So how can we think about that? So a way to escape from this, I would say, conundrum is to think as in terms of risk factors. Typically, you could think that a bad rating means a high exposure. So a bad ESG rating would mean a high exposure to ESG factors, meaning that when ESG factors are hit in a negative manner, your investment would be hit in a negative manner as well. But if you feel that markets basically are efficient, I don't want to enter into a discussion around efficiency, but basically that there is no natural difference between ESG factors and other factors. If they impact prices, it means that those ESG factors are priced in as well. So basically the implication of that is that if ESG factors are factors like others, they should be somehow priced in. And then the exposure on those factors should not be biased in a risk neutral, I would say, approximation. And even in a very simple model, it should, the risk and the exposure on a price factor should be symmetrical. And so if you see things that way, if you are heavily exposed on ESG factors, it means that you have a bad ESG rating. So it means both that you can lose a lot, but it also means that you can also win a lot of money. And it's, if you think about it, it's very, I would say, natural. In finance, markets are, I would say, built in such a way that generally, if you can lose a lot, you can also win a lot. It's just a way of telling that reward should be proportional to risk in some way. So here with this vision, the risk of a short position should be similar to the risk of a long position.
Sorry, I don't quite understand that because you're thinking about volatility, but there's also the trend, right? For example, if I'm long an oil stock, or if I'm short an oil stock, are you claiming that the ESG risk is the same? It
No,
seems,
so you're perfectly right. Here, so we didn't develop a whole theory with a general risk measure. Here, all what we say apply for volatility. So it's important to precise because in some asymmetric, I would say, risk measure, it would be different. So here I'm thinking about the volatility as a measure of risk, as a template. And typically, if we have the volatility template in mind to start with, also when you think about short, you think about long short, and you should there should be a difference somewhere in terms of final ESG risk between being long total and short shell in a long short portfolio, and being long total and short Rio Tinto, let's say, which is exposed to a totally different set of commodity price. So typically, you would like your ESG measure to be able to cope with some kind of correlation across ESG factors. Okay, so now how to organize all this thinking? Typically, what we'd like to propose is a model where, so maybe just to rephrase what I've just said before, you imagine a situation where you have a set of different factors, which is the addition of the set of ESG factors and the set of non-ESG factors. Obviously, they are totally not observable. This is a set of all factors impacting price. The total risk would be, in this situation, we start with the variance or the standard deviation in this situation, just to see what we can say with that simple measure. And the ESG risk would be the residual risk of a position when you know everything but the ESG factors. It's a kind of projection of on the ESG factors. And we could try to define ESG rating as a ratio between both. Practically, let's try to move forward and see what it would mean in practice. Imagine a situation where you have a vector, so X would be a vector of log price variation, so which would be some kind of trend somewhere. And in terms of risk, so an exposure on ESG factors and an exposure on non-ESG factors. So here WESG would be the Brownian motion that kind of models ESG risk, and the other ones, the Brownian motion that models the non-ESG risk. We suppose that they are independent. And here the beta are the corresponding rectangular exposure matrices that define the exposure on those risks. If you compute the covariance matrix in such model, okay, then the covariance matrix of returns would be the sum of the covariance matrix of, so it would be a beta transpose, and beta this one, beta transpose. So here I'm not saying much, but your covariance matrix would be the sum of the two covariance matrices, and the two covariance matrices, each describing the correlation structure of non-ESG risk and the correlation structure of ESG risk. But without further specification, we do what we want. The only constraint we need to have, if you think about it, since beta can be whatever matrix we want, and the size of W can be hundreds of thousands of factors, here at the end of the day, you have two constraints when you want to understand what would be this covariance matrix of ESG. It's just a sigma ESG should be a covariance matrix, so it should be symmetrical and positive definite. And also the difference between the return covariance matrix and the ESG covariance matrix should also be SDP. So you need to find a model where you have those two conditions holding. If you move forward, we say that, okay, we are happy with our review of the total risk. And our review of the total risk is that the volatility, we find that basically it's well-defined, well-observable, and we're happy with it. So we want to find the covariance matrix. So sigma here is a diagonal matrix with zero everywhere, and on the is row and column, you have the volatility of the is asset, okay? And we also have another diagonal matrix, which is R, which is a matrix of the ratings. So you have here two diagonal matrices, one of the volatility and one for the ratings. Okay. The variance covariance matrix of market is sigma, gamma, sigma. Okay. And here what we are looking for, since we want the rating to be a proportion of risk, we will look for an ESG covariance matrix of the form R sigma, gamma, sigma R. Meaning that on the diagonal term, if gamma, for instance, is the identity, you would find the square root of the square of sigma I multiplied by the square of Ri. Okay, so individually, you have the rating for each and every component of your investment universe. The thing is that you don't know exactly how to combine them. So in that framework, now we want to dig and to find the right correlation matrix. And the previous conditions becomes that gamma has to be a correlation matrix. So a correlation matrix, it lives in a space which is not that natural, I would say. The fact that you only have one, it's SDP plus one on the diagonal. So it's an intersection of two sets. And you also have this condition here, where the difference between gamma, the correlation of returns, and R gamma ESGR should also be definitely positive. Now, there are many correlations. So gamma, we start, we are with the view that the correlation matrix of returns, we don't know it, but we observe it with some, I would say, satisfactory precision. We are looking for some gamma ESG correlation across ESG factors. So there are many gamma ESG that could do the job, but the problem is that we don't have any clue about what we should take in terms of gamma ESG correlation matrix. So a way to start as a kind of prior is if let's consider that the contribution, the correlation matrix related to ESG is the same as the one related to return. So it's probably not the case, but it's a good starting point, or at least a starting point. And then we want to see whether it's possible or not. So with the empirical correlation matrix, do we have that condition the holding, which is the difference between the correlation matrix minus R gamma R, is it semi-definite positive? Probably not. If gamma is the identity in case of an investment universe where all assets are independent, so here this is the identity. I remind you that R, this is a diagonal matrix of ratings. The ratings are between 0 and 1. And so here on the diagonal, you have, on that one, you have 1. On that one, you have Ri square. Ri is between 0 and 1. So it's OK. 1 between 1 minus Ri square is always positive. So when all assets are independent, it's OK. It works. So this is a choice, and you could compute your ESG risk and do the aggregation. But it would be a pity not to take correlation into account. So what could we do to incorporate some correlation? What we try to do here is we try to find that correlation matrix gamma, okay, for the ESG metric, which is as close as possible to the empirical correlation matrix, and which ensures that this condition is that it complies with that condition. And for this, so since we know that the identity work in the case of all assets are independent, it's okay. We have the natural, I would say, idea would be to propose a shrinkage procedure, meaning that you would take a little bit of the empirical correlation matrix plus a little bit of the identity, and you would try to see whether the determinant of that. So this is a correlation matrix, that for sure. I mean, at least it's symmetrical.
Sorry, we cannot hear you, Nicolas. Okay, go ahead. Again, we cannot hear you.
Can you see it?
Yes, yes.
Okay, excellent. So here, so we have this shrinkage procedure. And basically, what does it mean? Maybe I will just, so, okay, I will follow the flow. So you find a correlation matrix, and here, now that you have a correlation matrix, you can define everything. You have the total risk, which you can compute with that correlation matrix, with the traditional, I would say, variance formula. You have the ESG risks that you can compute with that, I would say, formula about this correlation matrix, and with scaling the volatility by the rating. And then the rating, the ESG rating, would be the ratio between those two quantities. Okay, so in the single asset case, the total risk of a portfolio, if W is the leverage, is the absolute value of the leverage multiplied by the volatility. The ESG risk of a portfolio is that absolute value multiplied by the ESG rating and sigma. And the rating between both is the ESG rating, which means that basically this relates to the discussion we had initially, Rama, that the rating will move with the absolute value of the leverage, the risk, but the rating doesn't change. We have a specific issue when W equal to 0, but it's not very meaningful.
Okay, so you define the rating as the variance contribution of ESG risk.
Exactly, exactly. So some properties of this approach. ESG rating is independent of leverage. So it's interesting, particularly in the case of derivatives. Derivatives, if you consider that the volatility is of the same nature of risk as the underlying, it just as financially speaking, a derivative is just a variable leverage on an underlying. So if the leverage doesn't impact the ESG rating, then the ESG rating of a put, of a call, of whatever option on the S&P should be the ESG rating of the S&P. Interestingly as well is a case where all assets, so now I take the multi-asset situation where all assets have the same ESG rating R, meaning that R is the identity multiplied by a small r. And in this situation, if you follow the line of this calculation, the rating of the portfolio is also equal to R, meaning somehow that all the finance machinery, meaning shorting, leveraging, has no impact of this ESG rating if you move along those lines, if you move along the risk approach, risk being computed as a variance. Here, I've just run the calculation of the maximum acceptable ESG correlation in the two asset case. So imagine a situation where you have an asset which is R1 with a rating of 0.1, which is in our case considered as a very good rating, very low exposure to an ESG factor. Okay, so this is the green curve here, and somehow this is the maximum acceptable correlation when with an asset with rating displayed on the x-axis. So here is that point here. If we have an asset with rating 0.1 and an asset with rating 0.8, it's not possible to compute the ESG rating with a correlation which is above 0.50. 55%, which is natural. If two assets are very similar, you in this model you cannot reconciliate that with the fact that the correlation is very different, so to say. So if two assets are or if two assets have a very different ESG rating, the correlation cannot be too high. So this is how you can interpret that, I would say, shrinking procedure. Somehow it here, since the way you compute ESG rating and the way you compute volatility and correlation is totally different, there might be situation where the structure you impose is on the rating, ESG rating, is not consistent with the observed price and correlation price. So let's now move to a case study, which is our fund. So our fund, so one of our fund is on the Lixor platform. So it's a managed future program. So it means that it's a fund which is invested on futures. And for that specific fund, it's invested only on financial futures. So stock, government bonds, currencies, and short-term rates, no commodities. And I've taken this example because if you look at the MSCI website here, for all those stock indices, government bonds, you have a very good proxies for their ESG ratings. Okay, and it's natural to also identify a future which is equivalent financial position. So a future is just being long the underlying and short a short-term financing. And since we are with our risk approach, the financing leg is negligible in most cases with respect to the long leg, to the underlying leg, except for the case of short-term rates where we have to proxy something. Here, so well, what did we do? So we went on this MSCI website, and then we have taken, let's say I can take equities here. So the Hang Seng Index, if you look according to MSCI, it's rated A in terms of ESG rating. Eurostoxx 50 A, CAC 40 AA. And what you can see here is a B, double B, triple B are the small caps. Small and mid caps do not have a good ESG rating according to MSCI. Okay. We also have other things, bonds, currencies, whatever. And if now we can test our methodology. And what I display here is, so the orange line is the total, so ex ante volatility of our portfolio. It's a typical short-term volatility that you can see here on the left scale. Here, this is the ESG risk when you compute it with, I would say, the methodology we derived. And if you do the ratio between both, you have here the evolution of the ESG rating of our fund, which, the leverage we do can be very large on those contracts which have a very low volatility. The leverage can be 5, 10. And it can be quite short as well, because when you invest into currencies, short-term rates, the notion of long short is not very, I would say, relevant. It's just whether you finance yourself when you put money at work. And what you can see here is that depending on the period of time, whether we are more exposed on small caps or emerging currencies, they don't have a very good ESG rating as well. So in this situation here, and in this situation here, we were probably quite heavy on emerging currencies or small caps, long or short. And then this explains.
There's something I missed. So in your approach, you did not use these initial ratings. You used risk factors. So I thought you would start with some ESG risk factors, and then you would estimate your exposure to that. But it seems you start from MSCI rating. So how do you map one to the other?
So what we do here is that we take as given, this R here. We just say that, okay, we observe the individual risk as measured by external providers. And our, I would say, question is just how can we aggregate them in a consistent manner? And whatever the position of the portfolio, which can vary a lot. So this R matrix here is an input of our model. And this is, but this is the output of the model, which is whatever the position, we have those three quantities. So the blue one, so the orange one is one we are familiar with, which is the volatility of the portfolio. Here we are less familiar, those two one, which is the total risk, ESG risk of the portfolio. And then here, the risk normalized by the total risk would be the ESG rating, or we would interpret it as such. And that's it, basically. So basically, what we are proposing here. So being able to have an ESG rating at a portfolio level is important because not only for asset managers, but of course for end investors, it's nice to have a rating for each and every line. But if you don't know how to aggregate complex portfolios, it's basically useless. And so this is why we started with this methodology. So we don't claim this is the only one, of course. It's lacking a lot, I would say, of kind of axiomatic. We just started to dig into the volatility and variance. We interpreted the ESG risk as a fraction of the total risk, and that fraction, we kind of identify that fraction to an ESG rating. And with this, I would say, a view of things, we are able to derive at least some indication of the ESG rating of a possibly very complex portfolio. So what's next? First, we are at a time where we'd like to gather feedbacks, and of course, it would be interesting to have to test measures of risk which are not symmetric, as you proposed, Rama, of course, and see what could be said. And you have plenty of things to do, but so this is just, I guess, a starting point. So that's it.
Thank you very much. So I have one more question. I guess it's the same question. So I understood the first part where you start from exposures to ESG factors with some coefficient beta, and from that you can calculate the variance current contribution of ESG risk. Okay, fine. But then at the end, in the application, you take as input these ESG ratings by some agencies or MSCI, whatever. Mm-hmm. And how do you translate those into the betas? I mean, I didn't get that.
So yeah, so here I'm trying to set out what would be a kind of hidden framework behind the return formation. Okay, it should be something. If we see that you have two sets of factors, it should be something like this.
Yeah, but, this I understand. But okay, then when you have the ratings A, AA, so on, how do you translate those into numbers which you need to input?
So then after, with R here in this definition, R is the matrix of ratings that we take from external providers. So it's an input, because it's a rating of asset 1, asset 2, asset N. Okay. The volatility, it's also an input, an econometric input that we take, whatever estimator you'd like to use. And then we just have this question about what should we take as a correlation matrix. Okay, if we take the identity, we are sure that it's consistent with an underlying model such as that one. But if we take whatever correlation matrix, some of them could not comply with the structure imposed by this factor model, if you wish. Because the structure imposed that all of them has to be semi-definite positive. And if we want to start with a proxy of ESG correlation between return correlation, we can only do that if that condition holds. This is where we need a shrinking procedure. So we kind of find a correlation matrix where this condition holds. If this condition holds, we could write an underlying model where you have two sets of factors.
Okay.
And when you have
R?
that,
what is R? How is R obtained from the qualitative ratings? Because
so R is that diagonal matrix with those elements in the diagonal. So here we have an investment universe of
so
50.
That's your scale.
Exactly. So basically what we do, we take the MSCI scale,
okay, and you normalize,
which is between 0 and 10. We translate it into our scale between 0 and 1 with a straightforward transform and a unique transformation. And then we compute our ESG risk within this scale, and we retranslate in the MSCI scale.
Okay.
And that's how we do. And here, that example here, yes, it's just to show for a two-asset example the impact of the shrinkage. I've tried to put the total 50-50 or 70-70 covariance matrix, but it was very difficult to read. But practically what I can tell in our investment universe, which you can see here, where you have the most, I would say, of the usual suspects of bond markets, equity markets, short-term rates, and currencies. Optically, the shrinked correlation matrix is close to the empirical correlation matrix in most cases. It's always shrinked. So it generally never worked with the empirical matrix, but the shrinked one is reasonably close, meaning that we can really input and take into account the fact that typically, yes, I did not mention it, it's in the paper, but when the correlation is high, this formula here is very similar in mind if gamma is a very high correlation, almost non-definite positive, it's almost a weighted sum, because you have a kind of addition, and it's really almost like adding the very close to that formula here, just
Yeah, with the notional.
yeah, to that formula here, very close. And so it kind of rationalizes the fact that if in the equity sector, where the correlation across contracts is around 80%, it's not stupid to do a weighted average. And specifically computed a weighted average, ESG weighting average for the S&P, most correlation of most equities around 70%, let's say. So it's not totally stupid to do that. But where it would be really inappropriate were to have this kind of weighted average between a short-term rates contract and an equity contract, or an emerging currency contract and a short-term rates contract, where the correlation is quite low.
Okay. Thank you. So we have time for questions for Nicolas. Any questions?